This is Jack Wallace, and I'm here with Kevin Wilson with Home Team Lending. Hello, Kevin.
Howdy, Jack.
Howdy, Kevin. So, Kevin and I have been talking in depth, and one of the reasons we wanted to do these videos and to really reach out is we feel like there's a segment of the population that sort of has an issue when it comes to getting a loan. They have no issue with being able to afford a home. Let's
Correct.
start by saying that. And I think that's something that we sometimes have a problem with expressing correctly. You have high income net worth individuals, seven-figure net worth or more. They have lots of assets, lots of investments,
Right.
but they also have a really good accountant.
Correct.
And that accountant has done a really good job of sheltering them legally in taxation, but in doing so, they have made it where their income looks like they're making less money than a conforming or a normal loan structure would accommodate. So walk us through some of the scenarios and some of the ways that we can work around that.
Yeah, that's a great question, and you're correct. We have lots of individuals. You cater to many of these type of individuals that, again, they have the resources and the means to afford a home, a very nice home, by the way. Yeah. But at the same time, their tax professional has helped them. And I'm not a tax professional. I'm not giving you tax advice or financial advice.
Yes.
Yeah.
Yeah.
And so, but what we see, and we talk about conforming loans like you did, and the nature of a conventional loan, looking at tax returns, those individuals sometimes don't look as nice on those as they would if we were looking at the top line as opposed to the bottom line. And so again, their tax professionals have helped them get to a point where they legally are able to shelter some of their money and take care of those kind of things. We have ways for us to look at the top line as opposed to the bottom line and help those individuals get the home of their design.
Which I think that's a really important statement, the top line.
Yeah.
And the bottom line, and then the differences between the two, and that so much of the time our industries are built around the bottom line.
That's correct.
And that it really is important that you find somebody who knows how to work the top line.
That's
correct.
That's correct.
And it's interesting too, because when we say conforming loan, to a lot of people that's foreign. In fact, even to a lot of realtors, that's sort of a foreign. We all smile and say, yeah.
Right.
But the truth is, do you conform to the standard?
That's right.
And most high-income individuals have never really conformed to the standard.
Sure.
They've been a little bit more of a risk taker, more of a strategist.
Right.
And so what would be different about getting a loan on a house than somebody, you got to work strategies. So
That's right.
Let's talk about some of the strategies that are available that you can help people with.
So, and really it depends on where these individuals, when we're talking about this class of individuals, this high net worth individuals, some of them are still working. Maybe they're business owners. Maybe they have a vested interest in a company. That income or the money that's coming from those entities, from their business, their operation, we can do things like bank statement loans, both on their personal and or on a business bank statement, that allows us to look at those individuals based on the cash, the revenue coming in, and use an expense ratio to determine what of that is really usable for us. It's usually much greater than what they represent in their tax returns, and that allows them to have a much stronger buying potential.
And how is that? I guess this is where it gets into an interesting part of it, because we're talking about people that have used legal tax strategy.
Correct.
We're not talking about people who have, not done the correct thing.
Right.
So how is it legally that you can do that where you're working from that backward formula?
Okay, so when we talk about, in the term you use, conforming, or sometimes recognized as a conventional loan, those type of loans, we're qualifying the income of the individual or individuals based on tax returns and standard earnings from things like pay stubs and W-2s. The individuals that we're referencing, we're going to go look. It's going to be the same type of loan. So think about the loan itself being a 30-year fix. Think about it being a 5 or a 7-year ARM, cash out refi if we're in advanced stages of that home ownership. That operates the same. We're deriving the income portion differently. We're recognizing that they're a business owner and their W-2s are non-existent. They get paid through dividends. They get paid through distributions. So we're going to use the cash flow of the business. We're going to use the cash flow from the individual, depending on which type of those bank statement loans we go through, and we're going to pull that into a loan using, and again, same parameters of what you would call a conventional loan, just the income derivative is different.
So basically, just as an example, if somebody is writing off depreciation on a rental property, that's going to take it off the top for the taxes, but that really doesn't have any impact on you as far as what their actual income is. So that can be added back in.
That's
Is
correct.
that what we were talking about?
That's correct. So we're looking at cash flow. We're talking about
Okay.
the top line of what is coming into that is an entity. When I say entity, we're talking about business ownership. We're also talking about 1099, people that are subcontractors. So when we're
That's an interesting point.
that's correct. So we're not just looking at somebody who is the owner of a large corporation. We're talking about small business owners as well.
Which is the backbone of America.
For sure, without doubt. So if we can service those individuals and those loans, to put that back in and restate it, they operate or function exactly the same as the Fannie Mae, Freddie Mac from the standpoint of being 30 years or being some version of an adjustable rate or so forth. So we're not giving a loan that has potentially risky features in it, is the term we use in our industry. We're giving them a loan, it's just the income piece we derive from a different calculation.
Interesting. And so you're just getting their bottom number to a different number.
That's correct.
You're still going from a top number to a bottom number. You're just raising that bottom number by eliminating the things that don't matter to you as far as whether their credit worthiness or ability to pay it back.
Yeah, and
I think that's important. I think sometimes we forget,
Yeah.
like you said, I mean, I'm in real estate. I'm a 1099 person. So for me, it is the same thing. And
True.
so you go, there are a lot of things I can write off that really don't affect my true income.
That's correct. Those are expenses of your business. And
Yes.
so this type of loan recognizes you have business expenses. And again, that individual that is 1099 or self-employed, they're writing those things off as expenses of their business, which does take their bottom line to a different piece. We're going back and we're looking and seeing what it looks like at a different level based on the cash flow.
So would you call this a self-employment type of structure that you're looking at, or is this, when you're doing bank statement, is that really the person that you would be, is the key demographic there would be a business owner, self-employed?
That's correct. So either 1099 or self-employed company ownership. And that piece is at least 25% of when you're talking about the business ownership. If you're talking about 1099, they're usually wholly owned subcontractors. So again, there are parameters, no different than any other loans, guardrails that protect both the borrower, your client, and protect the lender themselves. But they're in place to recognize, as you said, a large percentage of our society, which the backbone of is small business owners, and we can
Sure.
service them for their home ownership through that.
So when they come to you, then let's skip ahead then
Yeah.
and say they come to you and they are a client with a great business, great credit, real money in the bank, and they would normally get declines.
Yeah.
So what does that conversation feel like on your side?
Yeah, so the process is much the same as it would be if they were an employee. We're going to take a loan application, and from that, we'll do that. And if it's a bank statement loan, for example, we'll take the appropriate number of bank statements and we'll gather what the inbound flow of money is through that bank statement. We'll apply what's called an expense ratio. And the expense ratio will determine on what type of business they are, right? If they're a service-based industry, then the expense ratio is much lower. There's not as much associated expense. If it's manufacturing, it's a higher expense ratio. So we're going to pull that income in and we're going to take the numbers and we're going to use that as their monthly gross income, much like if we were doing a traditional loan that we were taking their W-2s and giving a gross monthly from that. So it applies back into that loan application, and then we give them an approval at that point, and we go to work on getting the loan.
So the expense ratio is something that is determined federally, or how is that? Is that
No,
like
it's
a
by
standard?
it's by the lenders themselves, or the
Oh, okay.
investors actually determine that, and we can apply exceptions to that. So, for example, if we need, we can apply through an exception with the lender. So if they came in and said the expense ratio was maybe 35%, and we could say, well, they're more established, there's just not that much expenditures going on at the moment, their tax professional could write us a letter on their letterhead and simply say their expense ratio is more along these lines, and we would submit that to underwriting.
Okay, so now let's talk about, you said the appropriate number of statements. So I know there's 12 and 24 month,
Correct.
right?
That's correct.
Is that, those are the two that you
On
usually?
bank statement,
On
that's
bank
correct.
statement?
That's
So
correct.
then what determines which one would be the most usable for that individual?
So a lot has to do with the cycle of the business. So when you think maybe like a real estate individual that you mentioned before, they may have higher periods of income and lower periods of income. So if we take it across a broader distance, then we can recognize what
Do we need to average it out,
That's
basically?
correct. That's
Okay.
exactly correct.
And 24 is the maximum that you would go out.
It doesn't do us any good to do much.
So if you've had 2 bad years, probably not the best time to
That's
go
correct.
look at it. But if you've had 2 incredible years, this could be the time.
Fantastic time.
Okay, that's great.
And if we can do it in 12, usually we try and do it in 12 because it's less encumbering on the borrower, right? That your client doesn't have to jump through
Explain.
another hoop.
So then, okay, that's another issue. So are we looking at personal bank statements? Are we looking at business bank statements?
Sure, both.
Sure.
So and that's a question.
So that feels a little, I mean, that can feel a little invasive to people.
Well, we're not doing both. We're doing one or the other.
Okay.
So, and I'll give you an example of each. Let's say somebody is a self-employed individual, a sole proprietor. They're a business
Okay.
owner. Maybe
And
they
they
own,
commingle.
and they commingle their checking account.
I've
all
heard
right?
people do that.
Yep. And so we would be at that time looking at personal. If it's somebody who is a little more refined, even though they're the individual, but maybe they're a 1099 because they're a subcontractor. Maybe somebody is in the gig economy and they have 1099 from the single source. We would use, but they had a business account that they were pulling that into. We would recognize it through the business account. Business is preferred because it has less encumbrance on what's going on in the finance. We don't have to pull pieces apart from their personal.
Okay.
But it doesn't mean we can't do the personal. It's just an option. It's part of what you and I talked about in another conversation about meeting your borrower where they need to be. We have products that will meet them and your client base where they are right now. It's not one thing fits all or good or bad. It's what tailors to their need.
But I mean, it really is amazing how many times I've had somebody look at, I mean, they have a very successful business, they have everything, and then they get so frustrated because they want to buy this $1.5 million house, which they should be able to write a check for,
Sure.
but they can't get a loan for it.
That's correct.
And so those are the people that, piece of paper just dropped in the
Yeah.
background.
Somebody-
So those are the people that we are really looking at in
Yeah.
this situation,
That's correct.
and making sure we can service them.
That's correct. And there's been, I would tell you over the years, there was some people who had this concern that this type of loan had a much higher interest rate. And that's not the case right now. It may be higher, it may not be higher, but it's the reason that would apply is more based on the individual's parameters of what we're looking at with their business and the things of that nature, as opposed to in the past it just had a higher interest rate. The margins have separated down much closer today. So it's not
What would be the determining factors? Their personal credit?
exactly the
Okay.
credit worthiness.
Okay.
Yep, exactly. And
Yeah.
there's same parameters, zip code, credit worthiness, and things of that.
So if you have like a difficult file and you have a difficult credit, this isn't necessarily the best answer for you, or it may be the best answer, but it's going to be you're going to pay a premium.
That's correct. No different than an individual.
And I mean, I think
Same.
and that happens quite a bit. You have people that, when you're an individual who is depending on people for accounts receivable,
Right.
and you have a clientele that doesn't like to pay on time,
Sure.
and you have to make payments, I mean, that can get your credit in not always the best of places, but you can
right.
have a very successful business.
Yeah, that's correct.
So you're going to have to pay a little higher premium for that, but it's possible
Yeah.
within realm.
And I
What's
would-
the lowest on do you have a credit score that's the minimum?
So we can do stuff in the 600 range, not 600, but in the 600 plus credit
Okay.
score. It's not fantastic, but I will tell
And that's not our demographic that you're
No,
really
that's true.
appealing to, but if somebody there are those times when
That's right.
that
So
could be the answer.
even the differential between how much a down payment needs to be on a bank statement loan is dictated by what their credit worthiness. So somebody who has a 680 has to put down a little more money than a person that's a 720. Those are called loan level pricing adjustments,
Right.
just like they are with a traditional type of conventional loan.
But I have known people that were in the 680s who
Sure.
on every other level really had
For sure.
a great thriving business. So I think that it's just important to make people understand this doesn't necessarily mean you have to be sterling.
Yeah.
You have to be fiscally responsible. You have to have good credit, and you have to have shown income, but it doesn't mean you have to have been perfect.
That's correct. And a lot of times we'll see individuals, Jack, that'll use this type of loan because it's the season of where they are, and understanding that maybe
Isn't that every loan, every house?
For many of us, this is so even if it's a slightly higher interest rate, it may be the solution to get their dream home now that they don't miss on. There's nothing that would prevent them from refinancing in the future as their credit worthiness or credit score increased, or even maybe as their tax professional restructured the way that they're doing their taxes and they want it to go back to a more conforming type of loan. That again, you can refinance these loans just like you can another one as well.
Well, it sounds like a great program. And I think it's really important. Again, we're going to be trying to walk through some of the different loan types. And so this is called the bank statement loan.
Correct.
And let's just do a quick recap. It's
Yeah.
12 to 24 months of bank statements, depending whether you need to average it out or whether you can do it off of that initial 12. And mid to high 6 is a minimum on a credit score.
Correct.
And you're going to be basically looking at people that are 1099, self-employed, and really trying to figure out how to get their top line going to the bottom line a little higher than it would if they were applying for a standard,
Yeah.
normal
Yeah.
mortgage.
Yeah, Jack did a great job recanting that. Is it a solution for everybody? No. But is it a great solution those individuals that are self-employed or subcontractor employment? It's a fantastic product.
And let's be honest, that is the majority of people
Sure.
anymore. It feels like the gig economy and self-employment is, small business is really, and especially in Oklahoma, it feels like there's a lot of that.
So, I want to add one more piece that you and I haven't talked about. This is a great benefit of this product too, Jack. Let's just say that maybe one of the individuals in the household, one of the spouses has a business, and this type of product is perfect for their income, and the other spouse in the house has a job that's more traditional, and they get W-2s. We can take and use both in the same loan.
Really?
Yes,
You can hybrid those.
that's correct. So, great solution for a household
Interesting.
that has, and again,
So you're not just counting, because we have done that in the past where you have to count on sometimes the lower income spouse to qualify because they fit within the
now you got it.
qualifying of the
That's right.
conforming. Again, let's keep picking up on what we keep hearing people say, conforming, and we don't know what that means. This is what we're talking about.
That's right.
That lower income spouse conforms, and so you do it on that, but then the house that you could have, you could actually have a better house, a bigger house, a more
Sure.
expensive home if that's what you want.
Right.
By doing something like this.
That's correct.
Interesting.
yeah.
So it really truly is solving issues that we've dealt
That's
with
correct.
for a long time.
There's a lot of self-employed people that have started a company, and one spouse is in the midst of that growing and starting that company, has great numbers as they grow, and the other spouse has maintained a mainstream traditional type of occupation to help support, but we can use both incomes when we're doing
this is
it.
mind-blowing because if you really think about it, I think that's such a common scenario.
For sure.
Because people want the insurance with the one company, they want that steady income, but the other person is more the risk taker who goes out and then makes the majority of the income,
Yeah.
but we count on that other spouse to keep the house anchored.
That's right.
And so this loan
We
will
can-
accommodate those two.
That's exactly correct.
So if you heard nothing else, I hope you heard that because I think that is so many people
Yeah.
and they don't really know where to go to do that. So
Yeah.
where you need to go, I guess, is Kevin.
Well, I appreciate you taking time with me today.
Thank you, Kevin.
Appreciate it.
We'll talk soon.
Sorry, man, that just hit my head because we were talking about so much about the two, and I thought,